Okay, good afternoon, everybody, and thank you for joining this InvestEngine webinar in partnership with Xtrackers, which is all about investing in the US. I'm Andy Prosser. I'm the head of investments at InvestEngine, and I'm joined today by Lucas Anert, who's a senior passive product specialist at Xtrackers. Now, in terms of the plan for the webinar, it's going to be a bit of a Q&A. So I've got a few questions which I think people will probably want to know the answers to, so we'll start off with some of those. But I'm also going to be picking questions from the Q&A as well for the end. Now, if you do want to ask questions as we're going through, you can click on the Q&A button at the bottom of your screen. The questions aren't going to be broadcast to the whole webinar chat. They're just going to come straight to us. So no stupid questions. Don't worry about that. Absolutely fine. Just feel free to ask away and we'll answer as many as we can at the end. Now, it's my job to make sure that everything runs on time. So I need to make sure I leave enough time at the end, probably about 5 minutes, for a quick demo of how to buy some Xtrackers ETFs on the InvestEngine platform. I'm hoping that once we've wrapped everything up, the presentation, the demo, and the Q&A, we'll be ending the webinar at about 5:40 to 5:45. Now, before we get stuck into that, I'm going to hand over to Lucas. Lucas, maybe you can kick us off by giving us a quick intro just into who you are and who Xtrackers are, just for anybody who might be watching and who's not familiar.
Yeah, sure. Happy to do so. And also thank you very much all for joining us this afternoon. So maybe just really to set the scene a bit, the passive world is quite complex, so it does make a sense to give you a bit of an idea where I come from and then also what I do on a day-to-day business. And then we jump into those interesting questions that reside around the US and those big names in the US. Now, so I work for DWS. So DWS is a large German asset manager, exists for over 70 years, and we are one of the largest European players, not only in the passive space, but they're actually very different business lines that the company has. So there's a big actively managed book. There is a passive business. I work for that passive, so ETF business. And then there's also an alternatives business that DWS has. And the passive side of things, that one is called Xtrackers. So Xtrackers is really all about building blocks at the end of the day. It's almost supermarket offering, I would say, that we have. So several hundreds of different ETFs that just really aim to make different regions, sectors, themes investable. And we provide the wrapper that just makes that so efficient. Now, I personally work in a team that's called Index Strategy and Analytics. So the role of that team, and it's part of the product development side that we have, is really to identify indices that make the most sense to track with an ETF. There are, of course, many very large established benchmarks out there, your S&P 500s, MSCI Worlds, etc. Those are heavily followed. But there's also increased demand actually to build ever new indexing solutions, new ETFs to make new themes investable, or to, say, be more efficient about a regional allocation, for example. And that's also then something that we do in the team. We help to build these indices together with index providers and then make sure that we have an ETF that can track and replicate a certain strategy.
Okay, so it's fair to say you're a bit of an ETF expert then.
I hope so. I'll try my best today.
Okay, yes, before we get going, I do need to mention the usual disclaimer that your capital is at risk whenever you invest. This webinar is for UK clients only, and that none of this is financial advice. Okay, let's get stuck into some of the questions then. I'll give you a kind of trifecta to start with, Lucas. It seems like there are some pretty significant trends going on at the moment in individual stocks as well as in sectors and between countries as well. So maybe you could start with a kind of high-level overview. What are the trends that are going on at the moment? Obviously, one of those is the concentration in the US, which I'm sure you're going to talk about. Is that running out of steam? So that's kind of two. Third question, has the Trump election changed anything?
Yeah, so let's just dive in that straight away. I mean, as you mentioned, right? I mean, there are a couple of trends that seem fairly robust in financial markets. They've been going on for quite some time. And it's really kind of like a multi-level concentration trend that we see. And the highest level to observe that is probably simply if you look into country weightings and the way that different countries are represented in kind of global benchmarks. The left-hand side here is a good illustration of that. What we do here is we just break up the MSCI ACWI. So all country world as an index. That's a combination of kind of like all the developed markets and the emerging markets. And we can look at how the weights have evolved over time. The orange area, that is the weight of the US. And it is, I mean, on this increasing trajectory over the last couple of years already. It's a long-term trend. We show here the data since 2014. And the US kind of has been increasing in weight in that index quite significantly. It's now at 65% in kind of like a global allocation that many investors follow, right? So this is just a market cap weighted approach. And since it's market cap weighted, it really is then a reflection of performance. So past performance trends, they are reflected exactly in these kind of allocations. So the US has outperformed many other markets. If we look at the data in 11 out of the last 15 years, for example, the US has outperformed the other developed markets. And it's a similar story for emerging markets, which have also been quite compromised in terms of index weight. They now make up about less than 10% or so of such a benchmark-orientated allocation. Now, you might argue that, well, market cap weighting isn't the only way to look at country weights and assess the relevance different countries should play. And that is actually a lot of feedback that we get from our clients as well, right? Especially if we look at some of the institutional debates that we're having with clients. Some of those investors, they don't really lean into benchmark investing themselves or follow market valuations, but they tend to use other anchors to design their portfolio. And one interesting approach that often floats around is actually this idea of weighing countries by their GDP in their portfolio. As a long-term investor, that can make a lot of sense. There's some evidence behind that as well, that over very long horizons, countries typically don't really, indices and country indices struggle to really outgrow the GDP growth consistently. So really looking at GDP might be a bit of a fundamental anchor. And if we do that, and the numbers here in the middle of that slide, it again is quite impressive how the US stands out, right? So the equity valuation of the MSCI USA, so basically those around 600 large and mid-cap stocks in the US that we see, they're basically 2.2 times US GDP in terms of their valuation. And they are in a pretty select group up there. I mean, you've got Switzerland, you've got Denmark that have similar figures, but of course these countries are kind of like driven by single name stories where you've got national champions listed on the stock exchange that are kind of highly valued in regards to the country's GDP. But if you look into other developed markets, especially those in Europe, they're often only about 100% of their GDP, the equity market valuations there. So there's quite the gap, and that gap of course has been growing, and you can see it in the valuations then as well. So a typical way to look at this is just to compare a little bit where is the PE ratio, so the price to earnings ratios for different regions. And we can benchmark, for example, Europe and emerging markets versus the US. And the figures also there are then quite outstanding, right? I mean, the US market has gotten ever more expensive compared to other regional building blocks such as Europe or emerging markets. The right-hand side chart here shows that it's basically both of those regions are trading at about a 40% discount now versus kind of like the US market, and also below historical averages that we've seen. So there's a very robust kind of country concentration trend that we see. It's the rise of the US. And I mean, you brought up Trump already in your opening question, and the Trump trade to some extent is prolonging and fostering this trend almost by simply kind of like making that US allocation even more prominent. And for many investors, there's now little alternative really when it comes to equity market growth. They are looking at the US, and that's why they are so prominent in many investors' portfolios, not only in the benchmarks.
Can I just pause you for a second and focus on that right-hand chart? I think it's probably worth, because I'm sure there'll be some people in the chat who don't know what a PE price to earnings ratio is and what it's supposed to kind of signify. And so maybe just a bit of context around that right-hand graph and what it's supposed to be showing.
Yeah, sure. So the PE ratio at the end of the day is a measure to assess how expensive a company is versus the kind of underlying economic earnings that that company is making. So it's basically, it says into relationship the price that you pay for £1 of, say, earnings that the company is making. So the higher the ratio, the more you're paying kind of like towards potential future earnings, but it's not really present earnings that you're buying with that. So there's a little bit of a skew. Well, all that says is that basically the US market in terms of valuations has moved up. So investors are willing to pay ever more for kind of current earnings that are generated in the US on the outlook that the US market will be more profitable in the future, and hence they're willing to pay more. Whereas the outlook for example, European markets or also emerging markets relative to the US, that has gotten worse, and hence they're also willing to pay less for that. And that just opens up this gap. And we see that then translate into the performance differences of these regions.
That makes sense. Thanks.
Sure. If we jump to the next slide, we can then look into a second layer of concentration that is very worthwhile to point out, and that's on the sector side. So we can look into basically the same kind of analysis that we've just done on the country side. We can look at on the sectoral picture. So which sectors are the ones that grow over extended periods of times, and where have we seen maybe some increases in concentration? So if we go to the next slide, we should have that sector illustration in front of you. Yeah. So the two sectors that really stand out, and I think it won't be a surprise to many dialing in, is of course the information technology sector and the communication services sector. These two sectors, they broadly encompass kind of like tech themes and a lot of developments that we've seen over the last couple of years, and hence they have risen in relative importance across different regions. That's what the left-hand side chart illustrates quite powerfully, I find. So if we look, for example, into the US market, we now see that basically 40% of that US market is dominated by these two sectors, information technology and communication services. And many might say, well, in the US, there are those big firms behind it. It makes sense that that sector is becoming so prominent, but the US is actually by far not the only example where we see this happening. So we can also look, for example, into Asia. So if we look at an index, Asia ex Japan, and again do that sectoral look through, we find that those two sectors are also about 35%. So, and they're really on this upwards trend as well. Again, it's a 10-year picture that we look at here, and it is really shifting portfolio and investment realities quite significantly. With this rise of the kind of like broader tech super cycle, there's also always the question coming up, well, to what extent are these developments that we see actually backed by fundamentals, right? And that also takes us back a little bit to this idea of valuations that I was alluding to just on the slide previously. It is a little bit of an exercise that investors can go through to assess, well, why has the weighting changed? Is it because investors are just more bullish about a certain sector, or has there been kind of like actual underlying fundamental economic changes in the way that profits or revenues are generated in these sectors already? And if that's the case, typically some investors would say, well, then these developments appear a lot more justified simply because they are already kind of like realized to some extent. And the right-hand side, it is a little bit of a complex chart, but I'll try and explain it because I think it is a very important illustration. What we can do as well, we can first of all, of course, look at return differences. So the IT sector, if we pick that out now, that's the gray bar on the very right-hand side, MSCI World IT as a sector, information technology, over the last 10 years has returned 20 percentage points of return per year. That's a lot. It's a lot more than the broader index. has returned. MSCI World returned about 11 percentage points, which is also a very good run for kind of broader equity markets. And what we can then do is we can kind of subdivide those effects. So where's the total return come from? And those are the bars that you see on the left-hand side. And there are 4 categories here. And the one I think one has to be most mindful of is, of course, this idea of multiple expansion. And that goes back to this idea of PE values that I mentioned earlier. Multiple expansion basically happens if just the valuations of companies goes up, but not really the earnings capabilities of the companies go up. So a warning sign to investors is always if there's a lot of multiple expansion, but not many of the other drivers are actually behind the returns that we're seeing, because then they have less of an economic grounding. We can see some evidence that for the information technology sectors would be about 6.2 percentage points of that 20 percentage point return that comes from just multiples going up, companies becoming more expensive in that sector. But we also actually see very broad confirmation of other drivers. The 2, I think, that stand out are revenue and margin expansion. So revenue expansion is quite clear, right? So revenues, they keep on growing. Those companies in the IT space just have been better at growing their revenues than the average company out there in the MSCI World Index. And it's quite a big difference. And at the same time, not only have they generated more revenue, but those companies have also become better at actually turning revenue into profit. So that's the margin expansion. They've also grown their profit margins, respectively, compared to the MSCI World average kind of stock that is out there. And so that's always a good check to run through to assess, well, to what extent are these trends really sustainable? How much is just kind of like investor optimism, and what is already kind of like materialized? And if we look at that, and I think if we just look around us, I mean, the rise of technology is so prominent. It does make sense that those names and the sector overall is getting increasingly featured. With the tech sector, especially, of course, we then also get to the question of the single names pretty much immediately, right? And the next slide gives you a little bit of an idea of that 3rd layer of concentration that we're seeing. It's the single names, and it's especially prominent in the tech sector. So that MSCI World IT sector that I was discussing has about 140 stocks, for example, that qualifies information technology stocks in developed markets. But if we were to only look at the top 2 components of that, they make up close to 30% or so of that index. So that just tells you it's a very skewed landscape in the way that some of these indices are looking like. So it always is worthwhile to actually make a look through into the portfolios as well, into the indices. What are they holding? How are they composed? Because, I mean, one of the effects of market cap weighting at the end of the day is that those few firms that are kind of like benefiting the most and growing the quickest, they will also become ever more prominent in the index. And then for some investors, that of course first is a great source of return, but it then also becomes a risk at some point that they want to manage in a little more detail. And that the last couple of years really, so it's a trend that's been quite intact, at least over 24 months, have really been kind of like a standout episode in financial markets, where you had very few names outperforming the rest of the market and actually contributing most of the returns to global equity indices. And the group of stocks, I mean, many of you will be familiar with those, and we'll dive into them in just a second. They're called the Magnificent Seven. It's a set of US tech stocks that have been very, very successful and have seen strong increases in their performance, and hence also the benchmarks are changing accordingly. They make up increasing amounts of, say, an information technology benchmark, but also of an S&P 500 benchmark. And just to maybe give you an answer to that first question, to wrap up this first segment here, where we just wanted to go through these different cascades, I think heading into 2025, the evidence seems quite clear that there are still strong trends taking place. And what I've just described is kind of like, to some extent, fundamentally supported, right? We've looked, for example, into the rise of the tech sector and how that really was driven by earnings. But I think it's also, of course, part of the story that it's been a very extraordinary period. And typically, financial market history doesn't really look like that. If we look into extended periods, we do see some turnover. We do see some disruption. The winners of the past effectively are not the winners of the future necessarily. I mean, that's a very simple message, but it broadly holds if you look over decades of financial market performance. So that's, I think, one to keep in mind. And the right-hand side chart, I think, is a very useful reminder for investors. What we do here is it's just really a little bit of an illustration of that effect. We look into a long time frame, so since the early 1980s, and every single year we sample the top 10 stocks in the S&P 500. So whatever stock makes it to the top 10, we capture them. And then we look into, well, after those stocks reach their top 10 spot, how did they perform over the years that followed? And the message then is quite clear. The longer the period, kind of like the weaker the performance actually will be, at least statistically. If we look at this broad sample, the underlying dynamic is quite clear. It's disruption. So companies at the very top, they do get disrupted. We've seen that in similar or in other cycles before. If you look at the energy companies, if you look at car manufacturers, those were other innovation cycles we've seen in the market. And then always there have been some elements of disruption that kind of changed the landscape quite significantly. So it's almost to a point where basically the trends that I've described, they're so strong and so robust that raises questions for investors. And we see now many investors in the market actually turning around a bit and well, discussing diversification and portfolio construction a little more broadly.
So these two charts, just jumping quickly, it seems like they're kind of two sides to the same coin, right? The left-hand side chart is showing that the Magnificent Seven have done incredibly well since the start of 2023 and vastly outperformed the rest of the S&P. But the right-hand chart is kind of saying, yes, that's great. But the companies which, if we look at history, have got to the top of the pack and they become the top 10 companies in the US actually start to underperform the longer out you look.
Yeah, exactly. So, I mean, the right-hand chart is basically saying innovation or disruption is a little bit of a slow grind that you just statistically speaking, you would expect to set in. That's not saying, of course, that that's already visible next year, but at least if we look at the very long-term picture, that's what the numbers would suggest.
Okay, so you mentioned the Magnificent Seven there, and I think you did briefly mention that we were going to touch on this, but it's probably worth bringing up just so everyone's on the same page. If we are able to do a bit of a deeper dive into the Magnificent Seven, who they are, what makes them special, why they're doing so well.
Yeah, sure. Let's do that. So I think we've got a slide for that. Should be the next one here in the deck. And it's a very simple slide. It goes back to this idea of market capitalizations. So how valuable are certain companies? And just to benchmark that, I've put that versus the different countries that are investable. So those are country indices and single companies that you're seeing. The countries are in orange. No surprise. I mean, the largest equity market, for example, in the world, that is the US market. We've discussed it, will have a valuation of about $45 trillion. But then actually, you only find two other equity markets that as a group, where we look at the whole market, so that would be similar to the S&P 500 for the US, and for Europe, it would be kind of like the top 600 stocks in Europe. They are worth about 11 trillion. And then you've got Japan as another very valuable equity market. But you then already see the first couple of turquoise bars. The turquoise bars, those are exactly those Magnificent Seven names that we've discussed. It's a broader group. But there are, and many of those names will, of course, be very familiar with. They do stand out because they are all quite closely tied to this rising tide of AI. Right? So basically just companies that have been in a leading position going in. So basically before we had this kind of ChatGPT moment in late 2022, where basically the market realized, okay, there's massive potential here. And it turned out that those companies that were at the top of the tech sectors back then, those are the ones that are probably most able to capitalize from these trends, because they do have the financial resources to undergo extensive capex programs, to get access to chips. Some of them even produce the chips, or they've got the expertise to really develop AI-driven models, solutions, and really drive business on the back of it. And so hence the valuation of these companies, they went up very significantly. So you have a couple of those that are actually worth $3 trillion now. So basically where a single company has reached the valuation of an entire equity market. And you can look across the chart here, you will find markets such as the UK market, or also the German market, that is as a whole worth less than any of those 7 companies. So really quite outstanding of a situation. And for investors especially, I think a topic to look at in more closer detail, simply because those firms are all attached to a very similar theme. That's also, I think, one difference between the US market and the European market. In the European market, I mean, the whole market is on a much smaller scale, simply because valuations are in a different place. But also in Europe, there has been a trend where actually kind of like the biggest companies were the ones able to benefit most from recent developments. And those were the ones performing the best and contributing the most. So financial markets also introduced a bit of an acronym for them. They refer to them as the granolas. Basically, it's just their names, the first letters put together. And I've also put them here on the slide, just to give a little bit the size differences and in terms of scale, but also to give a feeling that actually those top names in Europe, they're much more diverse. Some of them are more towards the healthcare sector, some are more oriented towards luxury. So it's a very different group of stocks. The US stocks at the very top, they really stand out because they are so similar in many aspects.
We've actually had quite a few people in chat pick up on the Netherlands, which has apparently been promoted to a Magnificent Seven stock in this chart.
Now, I've noted that as well. It should only be the first 7 turquoise bars that count, and those are Magnificent Seven. And then Netherlands here should actually be orange.
Okay. So now we're all kind of aware of what the Magnificent Seven are, how they've been performing. What are some of the strategies that investors can apply to managing that concentration risk? Should they just be ignoring the US altogether?
Making an argument to completely ignore the US is, of course, very, very tough, right? Because as I said, 11 out of the last 15 years, it's been the better choice to look towards the US than to look towards, say, Europe or emerging markets. But what does make sense is to actually think a little more about the steering of that US weight. And the next slide just gives you a little bit of an idea of kind of like the broader index topics that we see associated to that. I've mentioned how the US makes up, say, in a global equities portfolio, about 65% of the weight. And many investors are market cap weighted investors. So they just follow these benchmark weights. For investors in Europe, we sometimes then hear that, well, actually, there might be a bit of a desire to express more of, say, for example, a home bias, where just following the benchmark weighting of Europe overall isn't really enough. And it can also make sense from various other perspectives. I mean, risk is one, right? I mean, we've seen some volatility in the dollar over the last couple of weeks. I mean, investing in the US always also means investing into the dollar and not really in your home market currency. So from that perspective, there's been a little bit of a trend where investors look more towards, for example, Europe again, but also emerging markets. And then it's a question of how do you effectively steer that? And that's where I think just this idea of index building blocks is very effective. There are a couple of big regions. I mean, we discussed them, and US, Europe, emerging markets. If you were to just build a portfolio out of the 3, you could have 3 different indices, and you kind of like just weigh them accordingly to your preferences. You scale them up or down as you see fit. And it's already pretty straightforward. But there's actually been kind of like a growing trend to make that even simpler. MSCI World ex-USA is a typical example of how indexing can be even more straightforward. What that is at the end of the day is just a solution that takes out the US out of an MSCI World Index. So rather than having 23 developed countries, it is just an index, market cap weighted index still of just 22 countries. It's kind of like the complement almost. And then investors can kind of like just break it down into a 2-layer kind of problem where they decide, well, what do I want to allocate to the US? For some, that might be the benchmark, kind of like weight of your 65 to 70%. Some might even go higher, but others might go lower. And then it's just really a 2-index kind of problem that you can boil it down to. And we've seen a lot of investor interest in kind of like just simplifying, allocating a little more and really taking this regional lens again. That's certainly one of the big comebacks of the last couple of years. Before that, investors were really just following the benchmark weights, but now simply because there are such skews in that, there's a little bit of a need to rejig that for some. And that's one of the trends and solutions that we see.
I think that's a really useful way to think about it, just having these kind of 2 building blocks, or a bit more granular if you want to kind of dial up or dial down your exposure to the US. Are there any other kind of ways or opportunities that exist for investors besides just focusing on regions?
Yeah, there are. And I mean, that's what I want to illustrate here a little bit with this second idea. So application number 2. What one is, of course, just to steer the regional weights, right? And the other one then really is this idea of thinking about, well, within the region, what is it actually that region or what index could best represent the regions and the opportunities that a certain investor sees in that specific region. To give you an example for the US, for example, I mean, once you've taken out the US of the portfolio by, for example, deciding to split it into 2 different chunks, and you have an MSCI World ex-USA index, for example, as one indexing building block, the US could still be in that portfolio, but it doesn't have to be MSCI USA, right? It doesn't need to be a market cap weighted allocation towards the US. It could be other opportunities that are out there in the market. It could be more of an equal weighted index, for example, or it could be more of a thematic index. So these are popular options that we see out there in the market. And so I just want to give you a quick illustration on one of those on the next slide. It is exactly that equal weighted index. It's a very simple premise that index is following. It, as the name suggests, just equal weights the S&P 500 and thereby avoids a little bit these concentration concerns that we've discussed. So it, of course, basically just weights every single stock at 20 basis points. So there's a frequent resetting, 20 basis points, so that's 0.2%, simply divided by 500. And then you just pro rata divide up the weights and you reset to those weights every now and then on a quarterly basis. And that just ensures that there's always a very high degree of diversification and the portfolio is tilted much more towards the average stock in the US market and less so towards those very big names that we've just discussed. So that's one way to approach it. And that just simply, if you look at the broader ETF market, is getting more popular. And then another way, and I just want to show the different options and the different thoughts that are out there in the investor community, right? It's on the next slide. That's this idea of, well, still allocating towards the US and investing into the theme of AI stocks, but just doing that in a different measure than using those very big names, the Magnificent Seven stocks that are basically overrepresented, some might say, in so many allocations already. So the next slide just goes into this in some detail and gives you some high-level figures about that. It's a thematic indexing solution that I showcase here. So what we're comparing now is basically just different means to construct the portfolio. Rather than market cap weighting, we can not only equal weight, but we can also weigh a portfolio by, for example, the thematic relevance of companies. So we try and determine well, how relevant is a company to the theme of AI? And then we weigh them accordingly. And you end up with allocations that are quite different towards versus what market caps would suggest. So that's one other quite powerful lens that investors can use just to screen kind of like the portfolio and to also assess different allocation options that might exist out there. So kind of like playing or acknowledging the fact that the AI trend is here to stay, but it's not necessarily the magnificent 7 companies that will kind of like be the ultimate winners of this trend. That is also, I think, one of those key ideas that investors are using at the moment to diversify a little bit their exposure to these mega trends of the present.
Right. Okay.
I see a lot of questions in the chat.
Yeah,
so
we've got a lot of questions.
I do want to move on to questions.
To put you on pause there because just aware of time. I've got a quick platform demo to do. So I think I'll just get that one done, and then we might have to overrun a little bit. We'll just see how we go. I'll try and keep this brief. Let me just share my screen so that I can demonstrate how to get exposure to all these themes that Lucas has been talking about today. Here we go. Bear with me. Here we go. Right. So here I've got a kind of dummy account to walk through. Once you're logged into the InvestEngine app on your phone or on the web browser, you can either open a new portfolio or you can select your existing one. You can see I've got a few demos here. I'll go into my DIY portfolio where I've got a kind of pre-populated one of 50% equity and 50% bonds. So what I'm going to do is scroll down here. You can see the 2 existing funds that I've got in here. All we need to do, it's very simple. We add securities, and then at the top of the page, when it comes up to browse investments, we click the nice big Xtrackers tile up here. And that brings up all the Xtrackers ETFs. You can see they've got a big selection of nice low-cost ETFs on the platform. Today, we've been talking about equal weight. We've been talking about NASDAQ, AI, big data. I'm going to search for equal weight, if I can spell it. Okay, let's go for that one. Then we simply click Add to Portfolio. And there we go. We can see in the top right here, that's now been added to the portfolio. We just continue. And this is where we set the weights. So we want to get rid of this one. And we want to stick 50% in there. We review and continue. And here, this is a nice screen that shows you what your allocations will look like under your new portfolio. So you can see that this would be an increase from 30% to 46.2% in North America. We're decreasing Europe ex-UK, which is what you'd expect because we're putting a US equal weight in there. We're having some slight changes to the sectors, and the holdings are changing as well. But once you're happy with all that, you save and continue. It says, nice big confirmation, target weights are updated. So all we have to do now is rebalance. Obviously, it's a demo account, so it's not going to work if I actually try and do it. But you click on options and rebalance portfolio. If it was an existing portfolio, that would just pull all of your weights back to your target weights, which we've set down here as 50% here and 50% here. If it was a new portfolio, you'd simply invest by clicking the invest button, or you could set up a savings plan as well, which is your kind of regular investing function. So it's as easy as that. I've kept that nice and brief. Hopefully it's quite straightforward. It's quite an intuitive platform. That wraps up the main bit of the presentation. So we've now got a few minutes to go through some questions. I am going to open up the Q&A box and see what we've got. Okay. Right, we've got somebody here, and this seems to actually be quite a common question. There's somebody with a global fund and somebody with an S&P 500 fund. Is that too much in the US? Should this person sell the S&P 500? Obviously, you can't give financial advice here, but how should somebody think about kind of constructing portfolios and having 2 ETFs that probably have quite similar exposures in them?
Yeah, so I mean, you've said it already. I can't give any advice here, but what I can say is that of course it does make sense, and that goes back to the first slides that I've shown, right? I mean, what you're looking at is basically a little bit of a cascading effect. So doing a complete kind of look through, actually across the portfolio is something that's becoming ever more important. Simply because you, for example, I mean, if we just take those two allocations. The global exposure will be 70% US, and of that 70%, about 30% will be in those magnificent 7 names, for example. And then, of course, the standalone US bucket also has, I mean, it's 100% US and is itself 30% in those top names. So just aggregating that up and then picking any of these lenses that I've illustrated, I think that already can sometimes help to identify a little bit the concentration concerns, be they single country, be they sectoral, or be they single name even. Because especially with those big and prominent names, they are in the S&P 500, they're highly reflected in the MSCI World, they're highly reflected in the NASDAQ index. So that's where it just adds up across the portfolio. And so a look through is always a useful exercise.
Yeah. And that actually answers the next question that I was going to ask you as well, because we see a lot of new investors tending to kind of stick everything in the S&P 500 ETF and just not do anything else. So I think you've kind of adequately highlighted the benefits and the downside of doing that during the presentation. Right, what else have we got here? Yes, question here on currency risk. This is always an interesting one when thinking about the US. What are the kind of advantages or disadvantages of hedging your currency risk? How do you think about currency risk in portfolios? Is it something we should even be thinking about with equities?
Yeah, very relevant question. I mean, traditionally speaking, and if you look at the broader market and the way that different types of investors are acting, right? Typically, the equity bucket wouldn't be hedged, simply because, I mean, I did allude to the fact that there can be significant volatility coming from the currency side, but I mean, the underlying is equities anyways. And equities themselves tend to have quite the high volatility profile, especially compared to bonds. So let's say in broad strokes, bonds, investors are typically a little more concerned about the currency side because it can drive more of your kind of total returns that I've seen. So hedging, if you're more on the conservative side there, can make sense.
Yeah.
For equities, it is then a question of, does it really change the picture fundamentally? It ultimately is then a question of also where, for example, the currency outlook is. Typically, a global portfolio has a global reflection of different currencies in there, and also just being diversified across currencies can be something that helps.
Yeah, I think that's a really helpful way to think about it. I've seen somebody in here ask about the costs of the ETFs that I was just mentioning there. And I'm very glad that I had a look beforehand and made sure that I knew the answer to this question in case somebody asked it, because we do get a lot of questions on fees, obviously. So correct me if I'm wrong here, Lucas, but I think the S&P equal weight has a cost of 0.2%, 20 basis points. The NASDAQ 100 is also at 20 basis points, 0.2%. And the AI and big data is at 0.35%. Does that sound right to you?
That sounds about right, yeah.
Yeah, good stuff. Okay. Right, we're almost at time, so let's take one more question. Oh, and there was a question here about.
I think one actually that I picked up from the chat here was in terms of weighting. There was one on basically the idea of revenue weighting versus market cap weighting, and I think it is an interesting one because I did discuss this idea of GDP weighting. I mean, revenue weighting is kind of like the third big prominent weighting methodology some investors go with. It's this idea of, well, reflecting on the fact that valuations might change, but the revenues of companies, they are a little more sticky, maybe. So just looking towards revenue does give a little bit more of, say, a quality bias in the portfolio. So it tilts the portfolio more towards quality. And that's certainly something that we see. So typically, I mean, just looking at to where actually revenues are generated right now. That is also one way to kind of like shore up the portfolio overall. So that it is a prominent approach. If you look into apply that, for example, to the country questions that I've raised, right? So what should the weighting of different countries be? If you revenue weight countries, different regions globally, the weight of the US would also come down. Because, for example, there is actually still quite some revenue that is generated by European companies, by Japanese companies, but their valuations at the moment don't really make that up in the market cap weighted lens. So it can be kind of like a useful additional pillar to look at, and there are still some investors who even use that as a primary means to design portfolios. So it is a valid approach. It's just that the fact that the last couple of years also revenue weighting would not have been really a strong performer versus the market cap weighting, simply because that's where all of kind of the growth potential really materialized, and a more kind of like defensive revenue tilt that would have resulted in a slight underperformance. But it also means a kind of like orientation towards more quality in the portfolio setting. So it is almost like a factor in the way that you can design a portfolio.
That is a great answer. Extremely comprehensive. Thank you. That is about all we've got time for, I'm afraid. Sorry, overrun slightly. We have got quite a few questions that are still coming through. If we haven't answered your question today, then we'll try and get back to you over the next few days. We've got Ewan in the background who's copy and pasting all the questions that we've got in chat. If you want your question answered a different way, you can always email support@investengine.com, and we'll get back to you there. If you want to find out more about any of the Xtracker ETFs, then just follow what I did before. Go onto the Xtrackers banner at the top of our ETF range page, and you'll find all the details there. So I think all that's left for me to do is to say thank you, Lucas. Thank you for your time today. That was a really interesting discussion. Thank you to everybody who's dialed in for joining. I hope you found it useful, and see you on our next webinar.
Thank you.
Thanks.